Hello, I wanted to take a minute to walk through the three primary scorecards that we have. So we have, and it's all available in the Discover tab. So we have the Global Liquidity Scorecard, which allows you to monitor the leading indicator, which is driving price, which is in the form of liquidity. So as liquidity is being injected into the market and or multiple markets, it usually appreciates and drives price rising and or declining, vice versa. And then the next one is the Macroeconomic Risk Scorecard, which we'll go through in detail. And that is looking at macroeconomic and geopolitical factors and what plays an important role in being able to project and forecast the risk of a recession, the probability of a particular set of events happening based on exogenous factors or external factors that are very important to track, like environmental conditions, catastrophic, natural catastrophic, like force majeure events, and so forth. So that's a very interesting scorecard that I use every day to every week. And then the Altcoin Market Scorecard. So we'll go through each of those, and that's focusing on the cryptocurrency and altcoin cryptocurrency market. So let's start with the Global Liquidity Scorecard. I'm really proud of this because these scorecards have taken so long. I mean, they've been such an exhausting process, but they're so helpful because they give you in one unified view. If I want to be able to look at the entirety of liquidity across all major developed markets in the world that will drive over 95% of all liquidity, you can see that through the liquidity scorecard. So right now, when I look at the Global Liquidity Scorecard, I can see that the US Fed Reserve is adding liquidity itself, which is a bullish indication. But I can see that cash returning to the markets, which is also positive. I can see that the net liquidity is 5.87 trillion. And then I also look at the overnight funding rate and be able to just track this spread here itself. So that's helpful on its own, but it's even more helpful when you look at it historically across multiple time periods. So for right now, if I'm looking at liquidity specifically for the US, I could see that you see in purple here is the Fed balance sheet itself. And it's finally now reverting back up and expanding, which we've been patiently waiting for. You can see that the US M2 money supply has also been growing. Liquidity has been rising. The reverse repo has been declining, which is okay. The Treasury or the TGA account has been slowly rising. And then what I like to use a lot is the M2 forward projection. So if you take the M2 money supply and then you forward project it 12 weeks, it'll be really helpful to be able to see whether or not the price of Bitcoin is going to go up or down. So if you just take the current price of Bitcoin and then you fast forward, project forward 12 weeks or 3 months, usually that will give you a very good indication of where the price of Bitcoin is. So you can look at this across a much longer time period and you'll be able to see a very clear pattern. And then you can see the price of Bitcoin as just one asset that you can pick and choose others. But really, ultimately, this view is helpful because it allows you to very clearly see, okay, money supply is 22 trillion, balance sheet 6.7, money parked is 2 billion, et cetera, which is about half of what the actual moving average is. And then a lot of this data is updated every day to every week. You can see the time frame here. So you'll be able to see, is it daily, weekly, or monthly? And this one right now, looking at the global liquidity, you could see that the money parked at Fed is draining. And then that's, or on this particular status here, right? But you can see it across like the last 1 day, the last 2 days, the last 3 days, etc. And then you can also see if you're doing short-term funding rate-based trading strategies, you can see quite a bit here as well. And then you can see the Fed operations, market price, monetary policies, and so forth. Beauty of this is that you can also see a unified country-by-country view. So there's just so much detail here that if you want to dig deeper, you can keep going into as much granularity as you want. You can look at the overall liquidity regime. You can see what's available, what's not available. You can look at also specific trade signals. You can look at risk. You can look at opportunity. Possibilities are endless here in terms of what you're able to do. And then the next one that I want to go through is the Macroeconomic Risk Scorecard. So the Macroeconomic Risk Scorecard, what I love about it personally is the most important component of it is it's allowing you to say, out of these 7 recession risk models, so it's 6 plus 1, that's a composite, that's model 7, what is the probability of us experiencing a recession, which is defined as economic contraction? And defining recession is actually quite complicated, because in the US, for example, they have a National Bureau of Economic Research, which is a committee that is the de facto committee that's responsible for identifying a particular period of time as being recessionary or non-recessionary. So, and usually what they will look at are a lot of the variables that you see here that we'll go through, specific metrics. But ultimately, you see on this graph, it's just so helpful to be able to see all the models overlaid on top of each other. So if I want to go and I want to say, okay, and then in red, if you can see it in slight red, that is past recession. So the most recent recession that we had was during the US COVID disaster that we had back in March and April of 2020. I'm sure everyone recalls that. It was a nightmarish scenario for everyone. But you could see exactly that the models were starting to trend upwards as the recessionary risk was increasing prior to the recession happening. And that's exactly the intent, and why this has been modeled and engineered in this way is for us to be able to accurately predict when the next potential recession could be. So if I only look at if I want to filter this down, I want to just look at the last few months. And then you see there's also a sort of a 6-month projection out. So by the end of this month plus 1 month, we'll be able to get the Q2 numbers in. So that's important. So when we get the Q2 numbers in, usually it takes about 30 to even 47, 48 days to be able to get the last quarter numbers in. That'll be very helpful to be able to see whether or not our forecast is accurate or inaccurate or needs to be recalibrated and fine-tuned to be able to be improved in terms of an accuracy standpoint. But again, back to the recessionary risks model. So there's 7 different models, and one is based upon our own proprietary formula that we use, where we're using gross domestic product, gross domestic income, employment level, income level, consumption, industrial production score, that's 0 to 100, and then delinquency rates. So that's delinquency rates, to me, is probably one of the most important early indications of what a potential recession would be. And then a second model is a GDP 2-quarter rule. That's usually what people use. And then there's also a yield curve. There's a Sahm rule, where it was a very famous economist named Claudia who created the Sahm rule. It actually has 100% accuracy, but only when it hits 100 or 0. That's the thing. It creates a bit of a noise with false positive when it goes up to 70 or 80, like it did recently. And then there's a credit stress indicator based model, and then there's leading indicators that are usually derived from volatility based indices and so forth. And then M7 is just a combination of all 6, right? But the main recession metrics are the same ones that I mentioned, which are here. And then you could also see the unemployment rate, the yield curve, inversion of yield curve, volatility indexes, jobless claims, etc. But these, to me, are among the most important in terms of being able to predict the next potential recession, is looking at delinquencies and debt. Because usually what you'll see is consumer loans and commercial loans and real estate loans beginning to default, and or delays in people being able to successfully repay their debt. So if you have higher debt obligation, you have higher rate of default, you have higher probability of insolvency, and then that drives you to a bankruptcy or foreclosure, depending on what asset class we're looking at. And that in itself complicates everything in your life. And if you are then just extrapolating from there forward, you could see how that has a bearing impact on the entire country's economy and the entire world's economy. So, and this is just for the United States. So you would look at this for all of the other markets as well, and you'd be able to take a closer look as well, of course. But you see, it's right here. So you can do the same for Canada, Japan, Germany, France, Indonesia, Saudi Arabia, South Korea, etc. Now, these are all the different markets that you would want to have where you can take a look at it and you could do it by country and by currency and then just refresh and it'll be up and running. So beauty of this too is it also allows you to be able to see our own proprietary geopolitical risk index. So this is scanning the entire world of geopolitical and macroeconomic risks and events that could potentially be helping or shocking the economy. And that is very, very important. So this is continuously scanning any potential threats that are out in circulation, like economic uncertainty, crude oil prices, like the Hormuz trade closure is having a very significant effect on the quality and the volatility and the integrity of the market itself. So geocom is very important, looking at yield curves, market volatility, consumer confidence. Credit risk appetite is hugely valuable for us to track as well. And right now, close to all-time high and multiple markets, including equities. So it is very much in a greedy market regime. And then you can look at also from the crossover of macro with liquidity and seeing if there's some opportunities there. There's so much. You can also look at the monetary policies and central bank policy rate divergences. So to me, this is very interesting because you want to see whether or not there's going to be any type of interest rate cuts or there's going to be a road to expansion or contraction. And usually if you reduce interest rates, then you make money more affordable, you make capital more accessible. And by doing that, you're expanding the amount of possibilities that companies and institutions can pursue, right? So they can pursue different acquisition opportunities, different private equity starts heating up, and then everything else starts booming. So usually you want reduction of interest rate to try to re-stimulate the economy and drive up demand, but you have to do it in a very careful and methodical way. Otherwise, you're going to drive up the prices of particular products, and then you're going to have inflationary pressure. So it's a very fine line trade-off that you have to balance, and that's why it's not as simple as, oh, well, reduction of rates drives up demand and drives up affordability. It's not that simple. It does make some assets like real estate and commercial property more affordable, but then it's also going to make the prices proportionally potentially go up. So these are the types of considerations. Now, the beauty of the Macroeconomic Risk Scorecard and the Global Liquidity Scorecard that we just went through is that it gives you that entire perspective into really one unified view depending on what you want to look at. And then on the back of it, you can set up very sophisticated alerts and you say, I only want to be alerted when the net liquidity is above, let's say, 7 trillion. And then you just write as many zeros as needed. And then you say, I only want to be alerted every hour with a 24-hour cool down. So it's like one time within a 24-hour time block. And then you can have it where any time that net liquidity is above a certain amount, and this is just an example of one condition, you can execute a particular trade on the back of it. And you say, I only want to have those trades executed on my Charles Schwab or my Alpaca Markets or my E-Trade or my Hyperliquid account, etc. You can have it all unified under one alert. So there's so much you can do with live trading and also with paper trading. So that's the whole point. It's not just theoretical. It's application-based trade execution. And it's being able to do that in a more informed way is my goal. So those are the two core global liquidity macroeconomic scorecards. And then the third scorecard is the altcoin market scorecard. So to me, this is extremely helpful, even if you don't have any actual financial exposure to the cryptocurrency market. Being able to know whether or not small capitalized, fast moving, fast growing companies or projects are outperforming in a very measurable way the rest of the market, it is very important to be able to track that. So if you know that we're in an altcoin season and the regime is very bullish, then you know that risk on assets tend to do generally well. So, and if it's bearish, you have to be more timid. Now, the way that it's designed is that there are 11 metrics that all roll up to a score that's indexed from 0 to 100, and the higher and the closer to 100 you are, the more bullish the regime and the market sentiment is. And what I love about it, and why to me it's just very valuable, and why it's been extremely useful for me, and why I'm really proud of how it's built, is that it truly does cover every sub financial asset class, because I'll walk you through it. So metric one, for example, it's looking at Bitcoin dominance. How much market share does Bitcoin drive at any one particular time? And then you have all the different 8 time periods. So you can say, okay, right now it's bearish to neutral, right? And then if you look at metric 2, that is Ethereum versus Bitcoin. So the largest cryptocurrency versus the second largest cryptocurrency in Ethereum, and it's looking at the relationship. And if Ethereum is outperforming Bitcoin, then that tends to mean and suggest that altcoins are showing a little bit of a sign of life, right? It's just like if you were looking at NVIDIA as a traditional stock versus the entire S&P 500, it is important to see that, to see if an NVIDIA or if Microsoft or Intel, et cetera, are outperforming the entire index. It's very valuable early indication. Third metric is Bitcoin. Is it strong or is it weak? Altcoins, are they outperforming Bitcoin? Are small altcoins, right, outside of the top 10, are they outperforming Bitcoin? And then stablecoin dominance. So when you look at the entire available pool of capital across the entire crypto market, I define that as the global stablecoin capital pool. So out of that total capital pool, look at the market capitalization of it, divide, and it's around, let's say, it's around like 270 to 300 billion. The entire market is worth a few trillion dollars. So if you look at the total global stablecoin market capitalization divided by the total cryptocurrency market capitalization, that's the stablecoin dominance. And it's around 12%. Usually, you don't want it to be 12%. That's quite high. So you would want it to be closer to 8 if you were being bullish on altcoins. So the fact that it's above 10 means that you really truly should be cautious and should be careful. Usually it tops around 12 to 15 at the absolute like abyss and the bottom of the bear market. So that metric in itself is extremely valuable. The same with metric 7. The infusion of capital being on-ramped into crypto, you need that to be strong. You don't want that to be weak if you have a bullish bias. And then DXY is the US dollar basket of currencies. So it's tracking the performance of the US fiat dollar versus the basket of currencies like the Canadian dollar, the British pound, the Japanese yuan, the Chinese yuan, etc. So that is very, very important. And then crypto versus the Russell 2000/Russell 3000 index. So Russell 2000/3000 are the 2000 smallest publicly traded corporations in the world. And usually when crypto outperforms those, that's a very, very good bullish sign. Same thing with crypto outperforming S&P 500 and then crypto outperforming the NASDAQ 100, which are the 100 most highly capitalized, most valuable publicly traded tech and infotech companies. So you could see that all of these roll up into a score out of 100, and things are basically neutral to bearish, like for this sector, right? And I think this perfectly encompasses the entirety of what you would need to know to just navigate this space. So for me, it's just extremely helpful. And then we have a momentum section that just allows you to see, is it rising or falling and declining? What's the level of acceleration? What's the level of strength? How often are we above a certain number, like how often are we above 60, which is bullish? How often are we above 80, which is very bullish? How often are we below 40, which is bearish, and below 20, very bearish, etc. So that's the altcoin market scorecard, and it's nice to just see, like, okay, are we in an altcoin season using like our 11 metric system, or are we in an altcoin season using, are you outperforming Bitcoin looking at specific coins? So these are outperforming, but that doesn't necessarily mean that the entire market is an altcoin season. So it's nice to just have all of the different models all together and allowing you to be able to see and make your own decisions. You're like, okay, when I'm purely looking at market capitalization, these tend to be outperforming Bitcoin, right? But when I'm looking at the bottom 10 performers, which are large scale projects, they're mostly underperforming Bitcoin, right? And then you can look at it as a sector by sector heat map as well, and be able to just see like which ones are heating up, which ones are not, looking at the sentiment score as well. So it's just very helpful, and looks at also the correlation. So uh, this itself is interesting, because a lot of people always say, "Oh, well, the S&P 500 is, or the NASDAQ." They always say NASDAQ is directly correlated with Bitcoin, which was true in the past, but right now that's becoming less and less true. Like if you look at the S&P 500, it's only correlated to Bitcoin 8%. Right? Ethereum, it's only 14%. I mean, that's not directly correlated or inversely correlated in any kind of meaningful way. But Bitcoin is directly correlated to Solana. It is directly correlated to Ethereum. It is, so that is true, right? You can't argue that. So the empirical data is there to support that. And then obviously this changes if you change the time period and so forth. But and then rotation signals is interesting, because you want to see whether or not specific sectors are rotating capital away from Bitcoin towards smaller cap, more speculative, highly volatile assets. But yeah, that is really that's the entire point of it. And then you can also when you have time go through the other modules. But today I really just wanted to walk through the main scorecards. So I hope that helps. If you have any questions, please just post them, ask them. I'm happy to help. Thank you.